All right, let's talk about something that affects every single one of us. We're going to tackle a really important idea today: how to move beyond just saving money and start actually building real wealth. For years, we've all been told the same thing: put your money in a savings account. It's safe, it's secure. But what if that's not the whole story? What if by trying to play it safe, you're actually guaranteeing that your money loses value every single day? Because there's this invisible force just eating away at your hard-earned cash. And that force, it's inflation. Here in India, it's been hanging around an average of 6% for a long, long time. Now think of that number as a kind of hidden tax. If the money you've saved isn't growing faster than 6% a year, well, it's not staying still, it's actually shrinking. And here's a really simple, kind of scary way to see how this works. It's called the rule of 72. All you do is take the number 72 and divide it by the inflation rate, so divide it by 6. You get 12. And that's it. That's how many years it takes for the buying power of your money to be cut in half. As financial expert Dhirendra Kumar puts it, if you have 1 crore just sitting there today, in about 12 years, it'll only buy you what 50 lakhs buys you now. That's a huge deal. Okay, so what are we really up against here? Well, it's these two silent forces that are constantly working against our savings. And this, right here, is where we need to totally flip the script. We have to change our mindset from just being a saver to becoming an investor. See, a saver plays defense. Their main goal is just not to lose the money they have. But an investor knows they're in a fight on two fronts, against inflation and taxes. So they have to play offense. Their job is to make their money grow faster than these things can eat it away. And if you need to see the difference, wow, just look at this chart. This is what Dhirendra Kumar calls the opportunity cost of just saving. Let's say you put 10 lakh rupees in a savings account. Over 15 years, sure, it might grow to about 16.5 lakhs. Not bad, right? But what if you put that same 10 lakhs in an index fund, which is basically just a basket of top company stocks? It could become 55 lakhs. That's not just a little more money. That is a life-changing difference. Okay, so to actually win this thing, you need a plan, a real game plan. And look, becoming an investor isn't about gambling or picking some hot news stock you heard about. It's about having a plan. A financial plan is just a roadmap for your money. It's a strategy that helps you figure out why you're investing, where it should go, and how much you need to put in to reach your biggest life goals. It replaces all the guesswork with real purpose. So how do you even build this plan? It's actually a lot simpler than it sounds. We can break it all down into 3 really straightforward steps. First, you've got to define what you're actually investing for. Second, you figure out when you're going to need that money. And third, you put the whole thing on autopilot. Let's start with step 1, goals. I mean, what are you even doing this for? What's the why? Are you saving up to buy a car, for a wedding, your kid's education? Maybe it's for a down payment on a house, or that dream vacation you've always wanted. Or, the big one, retirement. The more specific you can be here, the better. And this is why just thinking about those goals isn't enough. Because of inflation, you're aiming for a moving target. At a 6% inflation rate, the cost of pretty much everything will double in about 12 years. So that college education that costs 20 lakhs today, by the time your child is ready to go, you'll need to have planned for 40 lakhs. It completely changes the numbers. Okay, you know your why. You know what it's going to cost. Now let's get into the how. This brings us to step 2, setting your time horizon. This is so important because the timeline for your goal completely changes the tools you should be using. Think about it. For short-term goals, stuff that's only a few years away, you need safe, low-risk options like fixed deposits. For goals that are a bit farther out, maybe in the medium term, you can use a mix, like hybrid funds that balance safety and growth. But for those really long-term goals, more than 7 years away, that's when you can use the power of equity, owning small pieces of great companies to really target those higher returns. All right, let's get to the final piece of the puzzle, and honestly, this might be the most powerful part of the whole plan. And here it is, step 3. And the big secret here isn't about being a genius or timing the market perfectly. It's just about being consistent. Real wealth isn't built in one big, brilliant move. It's built through discipline, bit by bit, month after month. And the absolute best way to do that is with something called a systematic investment plan, or an SIP. So what's the magic trick behind an SIP? Well, it's this principle called rupee cost averaging. And I know, it sounds super technical, but it's actually incredibly simple and smart. It takes all the stress and guesswork out of investing. Instead of trying to figure out the perfect time to buy, you just invest a fixed amount of money on a regular schedule. And when you do that, you automatically buy more units when the prices are low and fewer when the prices are high. Okay, just look at how this works in real life. Let's say you invest 10,000 rupees every single month. In February, the market takes a little dip. That's great. Your 10,000 rupees automatically buys you more units. Then in March, the market goes up, so you buy a few less. Over time, all those scary market dips actually become your best friend. They become opportunities to buy more for less, and that lowers your average cost. You're literally turning market ups and downs into an advantage. And really, that's what it all boils down to. Just like Narendra Kumar says, this isn't about chasing some hot new trend or getting lucky overnight. Building real, lasting wealth comes down to two simple but incredibly powerful things: having the patience to stay invested for the long run and having the discipline to just keep going. So look, if you only remember one thing from all of this, let it be this: the power of just showing up consistently. That simple, automated habit of investing regularly is the real key to unlocking the financial future you want. And that brings us to a final, really crucial idea. In a world where we know we are guaranteed that inflation is going to chew away at our savings, the fear of investing has become the biggest financial risk of all. Doing nothing is no longer the safe option. Your financial future isn't going to be decided by having all the answers right now. It's going to be decided by the questions you start asking today. So I'll just leave you with this one. What's the first question you're going to ask to get started?